helping you to weather good and bad economies without putting retirement on hold. This is the Tumolo Financial Podcast with Ken and Nick Tumolo. Ken and his son Nick know that creating a comprehensive financial plan can align your hard-earned life savings with your retirement goals. Consider them your retirement architects. Now, the Tumolo Financial Podcast with Ken and Nick Tumolo.
Now, Nick, many financial advisors, they stick to that 60-40 portfolio, 60% stocks, 40% bonds. And the mix was hit hard when bonds collapsed under the weight of higher interest rates. But now the Fed has begun cutting. Morningstar's Jason Kephart was asked what is next for the 60-40. Take a listen to this.
So I think the trajectory for the bond portfolio is looking pretty attractive, especially from that defensive characteristic. So all the hand-wringing we've done over the last few years about the bond portfolio, I think that's over. I think we could rest easy on the bond portfolio for the foreseeable future. What it means for the stock market, we'll see. Recession fears are out there. Stocks are not going to do well in a recession. And you also have a lot of mega cap stocks like, everyone calls them Magnificent Seven, trading at very high valuations. So if there is a repricing, that can be kind of painful for the 60-40. But I think in terms of like the construct and the philosophy behind why you want to combine stocks and bonds, that's very sound. I think that's in a better spot than it's been since 2021.
So Nick, I'm curious if you agree with him. And then also, what do you think of the 60-40 portfolio in any economy?
Yeah, at this point where we are in 2024, I do kind of agree with him on the 60-40. All I mean by on the 60-40 is stocks and bonds. Seeing that interest rates are going to start coming down. We saw the first cut was 50 basis points, and they're projected to do a few more cuts, and they want to get back down to that 3% level for interest rates. What happens is when interest rates go down, bonds have an inverse reaction. So if interest rates are going down, bond prices should go up. So when that happens, especially when interest rates are getting cut at a periodic rate, usually what happens is bonds start improving. And because some of the fears of the recession did kind of go away, I know there is still some out there because there's a good amount of things still out there, the stocks will have a short-term bump. And we saw it with the first interest rate drop, which was 50 basis points. We saw stocks improve for the few days after. So short term, usually stocks do perform better. Back with the 60-40 mix, like for any economy, no, I definitely disagree with that. And the reason is it depends on your age, your lifestyle, your risk tolerance. So there's a few factors to it, but even just go with something near term. Back in 2022, if you held a typical 60-40 mix, and a lot of those 60-40 mix, if you look back at your 401k or 403b, your employer-sponsored plans, if you're not investing yourself, they usually will default you to a target fund. What a target fund is it's holding a basket of stocks, bonds, and maybe a little cash. And the closer you get to retirement, they'll hold more bonds and cash at the end. So usually when someone has, let's say, a target 25 or 20-30, it's typically close to that 60-40 mix. And if you held it back in 2022, when interest rates started climbing from 0 to all the way to 5%, and the Fed decided to basically weren't sure what they wanted to do. They started at 25 basis points, 50, and then 75. And when that happened so quickly, what happened was that 60-40 mix did not work well at all, because when you raise interest rates too quickly, bonds have an inverse reaction. So bond prices suffered. And because there was fears out there of recession and interest rates going up too quickly, stocks went down the exact same rate. So what happened was stocks and bonds went down exact same rate, which there wasn't a lot of protection in. Okay, if something does happen in the economy, those target funds really didn't perform that well in 2022. So what I like to do for our clients is when we're looking at a portfolio, I don't like to just look at, say, okay, we need to hold a 60-40 mix for someone that's 65, getting close to retirement, maybe a couple of years, or in retirement. I look at what they need. What's their lifestyle costs? What's their risk tolerance? I look at, okay, we know that Social Security and maybe a pension's coming in. That's guaranteed. How much more money do I need to live off of from my investments? And I like to look at it more of, okay, and we'll just use the 60-40 mix in this situation. Like I said, that mix could be different for anyone, but in a 60-40 mix, I like to hold 60% in managed funds where it's stocks and maybe some bonds. And then maybe that other 40% is really safety. And the reason is in retirement, you're worried about income. You're worried about where's that next check going to come from, even in good or bad times. So let's just bring up back in 2001 and 2008 when the market went down 50%. You wouldn't want to pull from your market investments because your market investments are probably going to be down at that time. And if you are pulling extra out of those accounts, then it could hurt you in the long term. So you build out that safe piece, and the safe piece, it could be anywhere from CDs, money market, U.S. Treasuries, fixed index annuities, stuff that gets you interest that can't lose money. That's what we like to use during those bad times. So yeah, I don't like to just hold stocks and bonds because bonds could go down. People will say, oh yeah, bonds are conservative. They are conservative, but they're not safe. And we saw that back in 2022. We've seen it in the past as well, where bonds have not performed as well as of late. And even if you look at the back, like the last 10 to 15 years, fixed index annuities actually have outperformed bonds. So you even start looking at a few of those things and saying, okay, what works the best for me? What am I trying to accomplish for my portfolio, my plan? That's where we build out that Tumolo retirement checkup. We do that complimentary. We have a couple different ways of reaching us now. We have the phone number, 860-854-3434. And we have a website, tfcheckup.com. That's where we can kind of start evaluating a few of these things. Like I said, this is complimentary. We can evaluate your investment allocation. We can go into more of the retirement plan. If you saved enough for retirement, kind of build out that plan so that when you're ready to retire, we pull the trigger and you enjoy your retirement.
Investment advice offered through Tumolo Wealth Management, a Connecticut-registered investment advisor. Content contained herein should not be construed as an offer or solicitation for investment advice or for the purchase or sale of any security, insurance, or other investment product. Please consult with a qualified financial, tax, accounting, or legal professional before implementing any ideas or strategies discussed here.